Airbnb was once hailed as the perfect disruptor of the lodging industry, a lean, asset light tech company that promised cheaper stays, unique experiences, and a better way to travel. But here in 2025, the cracks are showing. From mounting lawsuits, privacy concerns, inflated fees, and growing backlash over their impact on housing affordability, Airbnb's once flawless model is under serious pressure. Sure, they still offer stunning getaways, like the villa from the smash HBO series The White Lotus, but the hype and social media virality may be masking some concerning trends. While Airbnb's earnings have steadily increased since 2020, other key financials we'll explore later in this video suggest that its fundamentals and profitability are under pressure, and the market is growing increasingly skeptical about its long-term viability. In 2025, Airbnb finds itself at a critical crossroads, facing mounting pressure on its business model, growing market concerns, and rising financial strain. Can the once dominant disruptor survive, or is it on the brink of collapse? Stick around as we break down the challenges Airbnb is facing and whether its model can weather the storm. Airbnb has faced numerous lawsuits over the years, ranging from disputes with landlords to accusations of failing to prevent illegal listings. While the company's legal team is formidable and certainly not losing every case, these challenges are piling up, costing Airbnb millions in settlements and legal fees, regardless of outcome. The nature of Airbnb's business model inherently carries massive risk. Just think about it. As of the end of 2024, Airbnb had over 8.1 million listings across 220 countries and regions. From high altitude cabins to slick pool decks, that's a lot of potential liability. Airbnb recognizes this and has long positioned itself as a facilitator, not a provider, in an effort to limit liability. Unlike hotels, Airbnb doesn't take responsibility for maintaining a safe environment. That burden falls entirely on the host. But limiting liability is not the same as eliminating it. For example, this article from Morgan & Morgan, the largest law firm in the United States, outlines how Airbnb can still be held liable if it fails to enforce safety standards or address known hazards. That exact scenario played out recently when a Virginia family was awarded $1.3 million in a lawsuit after a drowning death at an Airbnb property. The court found the conditions were to be unsafe and hazardous. Beyond the financial damages, the family's attorney publicly called on Airbnb to overhaul its safety protocols, a serious red flag for a platform managing millions of unregulated properties. If local governments begin demanding stricter oversight, or if courts continue favoring plaintiffs in these type of lawsuits, Airbnb's liability exposure could explode. And the trend appears to be moving in that direction. Take this 2021 shooting at an Airbnb rental where a guest was killed during a house party. A judge recently ruled that the case can proceed, a clear sign of shifting sentiment towards holding Airbnb more accountable. A simple Google search yields hundreds of attorneys actively encouraging people to file claims against Airbnb for any harm experienced during a stay. In today's increasingly litigious society, that's a trend that isn't slowing down anytime soon. And it's not just guests. Airbnb is also battling local governments. For example, New Orleans now requires Airbnb to verify that all listings comply with city codes. That's over 4,000 listings in New Orleans alone that now fall under stricter scrutiny. If Airbnb fails to comply, it could face a cascade of lawsuits in one of the most litigious states in the country. While Airbnb is pushing back with a countersuit, this is hardly new. Cities like New York and San Francisco have also ramped up enforcement of local short-term rental laws. Whether they win or lose, these lawsuits are expensive, and recent rulings suggest that courts are beginning to expect more accountability from Airbnb. Combine that with increasing government scrutiny, and you've got the recipe for some very rocky waters ahead. Airbnb has increasingly found itself in hot water over hidden camera scandals. Guests have reported finding concealed recording devices in bedrooms, bathrooms, and other private areas, raising serious concerns over how well Airbnb can ensure guest privacy. While not every listing is a bad actor, the decentralized nature of Airbnb's model means there's very little oversight from the platform itself. With over 8 million listings across the globe, Airbnb relies almost entirely on hosts to self-disclose surveillance equipment and on guests to report violations after the fact. To combat this, Airbnb announced in March of 2024 that it would completely ban all indoor security cameras. While this is a welcome step forward, it raises the question, how will Airbnb enforce it? Unlike hotels, Airbnb does not own or operate its listings. This makes regulation incredibly difficult, and that leads us to the key point. The likelihood of encountering a privacy violation at a major hotel chain is significantly lower than at an Airbnb. Hotels are bound by strict corporate policies, consistent staff training, and industry wide privacy standards. Hidden cameras in a Marriott, Hilton, or Hyatt? Nearly unheard of, and if it did happen, corporate liability would be swift and severe. In contrast, Airbnb's open marketplace means anyone with a property and a phone can become a host, with limited vetting and virtually no in person inspection. So while Airbnb is attempting to tighten its rules, the company is still inherently reliant on trust, and that's a risky bet when it comes to guest safety and privacy. While Airbnb may have revolutionized the travel game with unique stays and cozy homes around the world, lately guests have been less wowed by the experience and more shocked by the bill. Hidden and inflated fees, especially cleaning charges, have become a major point of frustration. According to a January 2024 report from AirDNA, nearly 90% of short term rentals on Airbnb now include cleaning fees, and some hosts are taking it a step further by tacking on extra charges for things like emptying the dishwasher or taking out the trash. Even worse, these fees can make a stay that looked affordable at first glance suddenly feel a lot more expensive than a hotel. To combat this backlash, Airbnb rolled out a total price display feature in mid 2023, showing all fees upfront before you book. They've also been nudging hosts to ditch unnecessary charges, and by early 2024, nearly 40% of listings had removed separate cleaning fees altogether. The government also took notice. In December 2024, the FTC passed a rule requiring all platforms and hotels to disclose full pricing, including hidden fees. No more sticker shock at checkout. While Airbnb is making progress towards transparency, many travelers still feel blindsided by added costs. With regulators closing in and user frustration rising, inflated fees could be another reason why Airbnb's model is starting to show its cracks. As Airbnb has grown, so have concerns about its role in housing markets. While the platform was designed to let homeowners monetize unused space, in practice, it has incentivized the conversion of long term rentals into short term vacation properties, directly impacting local housing availability and affordability. According to multiple studies, the rise of short term rentals often correlates with fewer available long term rental units, driving up rent prices and property values in many cities. For example, research from Purdue University found that when cities like Irvine, California implemented restrictions on short term rentals, average rental prices dropped by 2.7%, offering significant annual savings to residents. Cities across Europe are seeing similar effects. Barcelona, in a dramatic move, announced it will eliminate tourist letting licenses by 2028 to return housing stock to locals. In Rome, increased tourism has led to evictions and cultural displacement in historic neighborhoods. These shifts are not just economic, they're reshaping the fabric of communities. To combat the strain on local housing markets, cities around the world have started enforcing stricter regulations. Vienna capped short term rentals at 90 days per year citywide. Florence banned new Airbnb listings in its historic center and incentivized landlords to return to long term leasing. New York City slashed Airbnb listings in 2024 following new regulation laws. Yet, even aggressive policy responses haven't always yielded immediate affordability improvements. In New York's case, affordability remained a challenge post regulation, underscoring the complexity of supply and demand dynamics in high cost urban areas. While Airbnb claims its impact on housing markets is overblown, the mounting evidence tells a different story. Cities are taking action, and if local government continues to view Airbnb as a threat to housing stability, we could see further licensing cuts, legal restrictions, and even citywide bans. This pressure doesn't just affect Airbnb's reputation, it poses a direct risk to its future inventory, scalability, and long term vision as a dominant force in global travel. At the beginning of this video, I mentioned we'd circle back to a few financial ratios. And now that we've walked through the lawsuits, legal pressures, privacy concerns, inflated fees, and housing issues, it's time to see how those things are actually showing up in Airbnb's financial health. We'll look at three key indicators: the quick ratio, current ratio, and market cap. And don't worry, I'll explain what each of those means as we go. First, we'll look at the quick ratio. The quick ratio tells us how easily Airbnb could pay off its short term bills if it had to, using only its most accessible money. Airbnb's quick ratio has dropped from 1.3 in 2021 to 1.1 at the end of 2024. That's still above water. Anything above 1 means that they have more liquid assets than they do short term debts, but the cushion is getting thinner. And with all of the lawsuits, legal fees, and tighter regulations we've talked about, less wiggle room is not a great place to be. Next, we'll look at the current ratio, which includes everything that the company owns that could be used to pay off short term debts. That number has dropped from 2 at the end of 2021 to 1.7 at the end of 2024. Again, still decent, but it's heading in the wrong direction. It suggests that Airbnb isn't as financially flexible as it once was, and that's concerning in an environment where they're facing lawsuits, government pushback, and pressure to change their entire pricing model. Finally, we'll look at the market cap or market capitalization. This is just a fancy way of saying what the investors think Airbnb is worth. It's calculated by multiplying the company's stock price by the number of shares out there. And here's the kicker: Airbnb's market cap has been shrinking since 2021. The stock is actually trading lower than what it was 5 years ago. That tells us that investors aren't convinced by the growth on paper. They're worried about whether or not that growth is sustainable, especially with all of the pressure that Airbnb is under. So, what's the bottom line? These three numbers tell us that the issues that we talked about in this video aren't just headlines. They're starting to hit Airbnb where it counts, their financials. Less liquidity, less flexibility, and falling investor confidence points to a company that might be growing but is also facing some serious headwinds.